All right, let's talk. As your guide, my job is to help you cut through all the noise you hear about the market. When you hear stocks are up or stocks are down, it can feel like this huge, complicated thing. So today, we're going to build a really clear, simple plan for your investments using one of the most powerful tools out there, the index fund. Let's dive in.
So, just to put things in perspective, let's start with this number. In 2016, there were 4,333 different stocks on the U.S. market. Now imagine trying to pick the few big winners from that massive list. It's like trying to find a needle in a haystack, right? It's totally normal to feel a little overwhelmed by that.
And that really is the million-dollar question, isn't it? How do you actually get a grip on what the market is doing on any given day? Well, the good news is you don't have to track every single one of those companies. Nope. There's a much smarter, much simpler way to get a read on the market's direction.
And that simple gauge is called an index. Think about it like this. If you wanted to know the temperature of the ocean, you wouldn't try to measure every single drop of water, right? Of course not. You take a sample from a few key spots. An index does the exact same thing for the stock market. It just tracks a specific group of companies to give us a clear picture of the bigger trend.
This idea actually has a pretty cool history. It all goes back to 1896 with a financial journalist named Charles Dow. He just picked 12 popular industrial stocks, averaged their prices, and suddenly investors had a single number they could look at to see how the market was doing. That simple but brilliant idea became the Dow Jones Industrial Average, which now tracks 30 big companies and has literally inspired thousands of other indices all over the world.
So let's just be crystal clear on what an index is. It's basically a metric, a tool that tracks the performance of a sample of stocks. That sample is supposed to represent a whole country, or maybe just one sector, like technology. And honestly, the actual number itself, the level of the Dow, doesn't matter nearly as much as its percentage change over time. That's what tells you if the market's going up or down. For a really long time, an index was just that, a gauge, a benchmark you'd compare your own investments against. But then a truly brilliant idea started to take hold. Investors started thinking, wait a minute, instead of trying so hard to beat the market's average, what if we could just buy the average?
And that's exactly what an index fund is. It's a special kind of fund, could be a mutual fund or an ETF, that's built to do just one job: copy the performance of a specific index. It does that by simply buying all, or at least a representative sample, of the stocks in that index. So if the index is the map of the market, the index fund is what lets you buy the entire map.
So, why did this idea become so popular? Well, it really boils down to three huge reasons. First, it's an incredibly easy way to get diversified. Just like that, you own a tiny piece of hundreds of different companies. Second, the costs are usually rock bottom. That's because the fund isn't paying some high-price manager to pick stocks. It's just following a recipe. And third, it's the heart of what we call passive investing. This belief that just matching the market's return over the long run is a better bet than trying to outsmart it. And has that strategy paid off? Well, history gives us a pretty clear yes. Take a look at this number. That was the 10-year average annual return for the S&P 500 index as of mid-2016. By just mimicking the market, investors have actually done really, really well for themselves over the long haul.
Okay, but it's not quite as simple as just grabbing any old index fund and calling it a day. And this is where, as your advisor, I've got to tell you, we need to pop the hood and see what's really going on inside. There are some absolutely crucial details you need to understand before you put your money to work.
So here's the first thing you have to know. An index is just a theoretical measurement. It doesn't have any real-world costs, but your index fund does. It has small management fees and some costs for buying and selling stocks. And because of that, your actual return will always be just a tiny bit lower than the index it's trying to copy. That's totally normal, but it's something you've got to be aware of.
Now check this out, because this is a perfect example of why looking under the hood is so important. Not all indexes are as diversified as you might think. Take the NASDAQ composite. You might think you're buying a nice broad mix of companies, but look at this chart. A whopping 42.5% of it is tied up in one single sector: information technology. That's not really broad diversification. That's actually a pretty concentrated bet on tech.
And this all leads us to maybe the most important question you can ask when you're picking a fund. How is it even possible that two different funds, both supposedly tracking, say, large U.S. companies, can have totally different returns? Well, the answer is all about how they're built.
It all comes down to how the index gives weight or importance to each company. A price-weighted index, like the Dow, gives more influence to stocks with a higher price per share, which is a little weird, right? Then you have a market cap-weighted index, like the S&P 500. This is the most common, and it gives more power to the biggest companies. So your investment will be swayed more by giants like Apple or Amazon. And then there are things like an equally weighted index, where every company, big or small, gets the same seat at the table. Each one of these methods gives you a totally different view of the market.
And this, right here, is the single most important thing to take away from our chat today. Choosing an index fund is not a passive decision. You are actively choosing a method. You are deciding if you want your money to follow the biggest companies, the highest priced stocks, or if you want to treat every company the same. Understanding this is the absolute key to picking the right fund for you.
Okay, I know that was a lot of theory, but you really need to get it to make a smart choice. So now that you understand the mechanics, let's turn all this knowledge into a practical, real-world action plan. So here it is, your 3-step homework assignment.
Step 1, find an index you like. Just decide what part of the market you want to own. Is it large U.S. companies with the S&P 500? Maybe you want international stocks. Step 2, search for funds that track it. A quick search online for S&P 500 ETF will give you a whole list of options. And step 3, and this is the most critical part, read the fund facts document. For any fund you're seriously considering, you have to find and read its official fund facts or prospectus.
That document has all the secrets. You're looking for 3 key things. First, the cost. They usually call it the expense ratio. The lower, the better. Second, it's tracking performance. How well has the fund actually done its job of copying the index? You want one that hugs its target closely. And finally, look for any modifications, like its weighting method. Does it use market cap or equal weight? This is how you make sure you're buying exactly what you think you're buying.
Hopefully this has shown you that even a simple tool like an index fund has some important details to understand. And if you appreciate this kind of clear, straightforward financial guidance,
Then please think about subscribing to Finance Unfiltered. We're all about breaking down complex topics just like this one to help you become a smarter, more confident investor.
So I'll leave you with this one thought. An index fund gives you the map to the market. It's a fantastic, low-cost way to get diversified. The only question left is the one you see right here. Thanks for joining me.